Hi, everyone. My name is Jacob Simons. I'm one of the senior wealth managers here at the Rice Partnership. I'm also a CFP professional. I'm joined today by Ashley Wilken, a fellow CFP, but also a CTFA and partner at the Rice Partnership.
Hey, everybody.
We're coming today, June 5th, for our monthly client video. I had a couple topics I wanted to talk about. So, Ashley, one of the things that we see a lot in the news right now, there's a lot of uncertainty with things that are going on over in the Middle East with Iran and the Strait of Hormuz. The price of oil is up. The stock market can be volatile. Uh, there's unknowns at the Fed and what's happening with interest rates and how that's going to affect bonds. With all of these different things and uncertainty across all of these different sectors, we have gold that's been on a huge run lately, but there's speculation as to how that's going to perform going forward. With all of these different things in mind, how do we go about constructing an asset allocation, or how do we go about, deciding how much of which of these different holdings should clients be holding?
Yeah, that's a great question, Jake. Clients are asking that all of the time. How we approach asset allocation and investing is, first at the individual level. As advisors, our job is to work with each individual client to figure out what their individual goals are, what their long-term objectives are, what their cash flow needs are and will be in the future, and also their risk tolerance. So, long-term goals, risk tolerance, and cash flow are the three main things that we're looking at when we're recommending an asset allocation. Also, different buckets of money and different accounts could have different goals. And therefore, we're going to recommend different asset allocations based on the individual account level, within the greater financial plan, holistic financial plan for the client. So, yes, all of those headlines, are important, and, could impact the portfolio. The investment management team is constantly looking at the news and making minor adjustments within the overall portfolios. But, what we do as advisors, the overall broader asset allocation recommendations do not change as frequently as, the underlying stocks might.
Yeah, that's good. It shows the importance of how a financial plan can really help tie this together. So, if we've seen some sectors this year have been on a big run and some sectors are underperforming, anything to do with AI has just gone through the roof. Why would a client, have money in an energy stock that's not doing so well with versus just saying, let's put all my money in Nvidia and Micron. Those are doing great.
Yeah, that's another great question. And of course, when you have a couple of stocks that are doing really well, it's hard not to wish that all your money was in those. But as history's told us, we are long-term investors, so we're looking at the long-term, preservation of wealth and growth on a risk-adjusted basis. And, history has told us that it is very important to be diversified across, all sectors
Hmm.
most of the time. There have been times, when we haven't been invested in some of the smaller sectors, if they've been out of favor. But in general, I would say, we're pretty uh, balanced across all the sectors of the economy, even when certain sectors might be out of favor. And the importance of that is that, not everything moves in the same direction at the same time. So, if you put all your eggs in the tech basket, and tech's going good right now, it's also going to probably all go bad at the same time. So
Hmm.
having some stocks that, might have negative performance this year, along with stocks that have positive performance, will hopefully help protect the portfolio when the, pendulum swings and tech goes out of favor and those other sectors are back in favor. So really, when we're planning for long-term 10, 20, 30 years down the road, we want to maintain that diversification.
Yeah. So if somebody wanted to just be low risk and you can get bonds and treasuries and money market that's all yielding, decent yield right now, 3, 4%. Why not just put all my money there if I'm not wanting to risk the pendulum swinging or the fluctuations of the stock market and just go with a fixed income and bonds only?
Yeah, and that's another great question. And we definitely do have clients that, are only invested in fixed income. 4% state and federally tax free is very attractive for clients that, especially in Hawaii and California, where we have, two of the highest state tax rates in the country. However, back to the long-term time horizon and also the individual's goals. If you are, an individual that has a long-term time horizon, typically stocks are going to be an important part of your portfolio. And history, again, has shown us, since 1950 up until recent times, 60/40 portfolio on a 10-year rolling average has never been negative over that period of time.
Hmm.
So again, if you're invested for at least 10 years in a 60/40 portfolio, historically, you've never lost money over that period of time. And you also have better chances of having, uh, bigger returns above inflation. So when you look at
Hmm.
inflation adjusted returns, the, 4% doesn't look as attractive, after inflation compared to a balanced portfolio. So again, you need to talk to your financial advisor, figure out what strategy works for you. But then once you come up with that strategy with your advisor, very important to just stick to that plan throughout, different cycles, different volatility. It's the investment team's job to, make the small changes between the sectors. But in general, the asset allocation for clients, the long-term objectives don't change very often.
That's really good. It reminds me of my favorite kind of cliche adage of it's more important, your time in the market is more important than timing the market. And so keeping that long-term mentality is the right way to go. Awesome. Well,
That's
thank you,
exactly
Ashley. I
right.
appreciate your time. If you have any questions, you can always reach out to us. Thank you.
Thanks, Jake.